So today, inshallah, we have chapter 6, and chapter 6 in accounting is discussing the idea of the cash flow statement. Okay, the title of the chapter is Measuring and Reporting Cash Flows. As you can see in the presentation here, the learning outcome will be first we will discuss the crucial importance of cash to our business, and that also includes the importance of cash flow statement and what information we can get from the cash flow statement. The second point is to explain the nature of the statement of cash flow and discuss how it can be helpful in identifying cash flow problems. So sometimes we have problems in the cash flow, we will identify it using the cash flow statement. Third, we will prepare a statement of cash flow, and we will see how can we prepare the statement of cash flow. Actually, there are two methods. We will discuss those two methods, inshallah, and we will have an example of creating or preparing a statement. Finally, we will interpret the statement of cash flow, and this part we will take it in this. The definition of the cash and cash equivalent. You know that in business, the cash is very important. Using the cash, we can buy what we want in the business. Like, for example, if we are in the retailing business, then we use the cash to buy the supplies, okay, or sometimes we buy the products that we will sell again to the end customer. Okay, and also using cash, we can also buy some assets like non-current assets or the fixed assets in the business, and that help us in increasing the asset of the organization. So the cash is very important, and a lot of people say that cash is king. If you have cash in business, then you can increase your business. Okay, you know that the cash is also bringing another cash. So what is the cash? The cash are the money, the notes and coins in hand, and deposits in banks and similar institutions that are accessible on demand. So the cash that we all know what's the cash and how can we differentiate between cash. The cash equivalents are the short-term, highly liquid investments, like for example, the stocks, okay, or the bonds. Any short-term investment that we can liquidate it, okay, we can make it money in a speed way or in a fast way. Okay, quickly we can liquidate the cash equivalent. And the most obvious example here is the stocks. If the company buys some stocks from the market, from the stock market, these stocks can be defined as cash equivalent. And anytime the company wants to change those stocks into money, directly they sell those stocks in the market and get the money directly. Okay, what is the relationship between the three statements? This issue we already discussed it, but we will discuss it here in just as a summary. Okay, we say that, for example, if you see here in the left side of the presentation of the slide, we have what we call the equity, okay, and the cash and cash equivalent, and these two items we can find them in the statement of financial position, okay, or as we call it before we name the statement of financial position, we named it as a balance sheet. If you remember, we can create or we can prepare the balance sheet at the start of the accounting period. Like, for example, at the beginning of the year, we can prepare the balance sheet, and at the end of the period, like at the end of the year, we will prepare another balance sheet. Between This one, the balance sheet that we created at the beginning of the start of the period, and the one that we created at the end of the period, the income statement and the cash flow statement are prepared, okay, to reflect. This one will reflect the performance of the business, which is the income statement, and the statement of cash flow will show us the cash inflow and cash outflow. And what is the difference between the cash inflow and cash outflow? The cash inflow are the cash that enter the business. Like for example, the sales we can consider sales as cash inflow because we receive money from the sale. Or sometimes we invest in another business, or we can invest by, for example, buying non-current asset or fixed asset. The investment here, if we invest in fixed asset, that means we buy fixed asset, this is cash outflow because we pay the cash. So cash inflow, receiving the cash, and cash outflow, paying. So the income statement and cash flow statements reflect a period of time, whereas the balance sheet reflects only one point. So yeah, here in the balance sheet we have the equity. For example, if the equity was 10,000, for example, at the start of the period. During this period, we have a lot of sales and we make some profit. So at the end of the period, okay, the equity here will increase, okay, because of the profit that we make. And you know that the profit will be added to the equity that we prepare at the end of the period. For sure, equity here will be greater than equity here. Whereas here the cash sometimes will be less than the cash at the end of the year, sometimes will be more. For example, if the cash inflow was more than the cash outflow, that means we increase the cash at the end of the period. Otherwise, if the cash outflow was more than the cash inflow, that means the cash at the end of the year here will be less than the cash at the beginning of the year. Okay, this is the standard layout of the statement of cash flow. We have three components in the statement of cash flow. We have first the cash flow from operating activities, and we have cash flows from investing activities, and finally we have cash flows from financing activities, and we will discuss each one of them. But here, by adding the cash flow from operating activities to the cash flow from investing activities and cash flow from financing activities, we will have what we call net increase or decrease in cash and cash equivalent or liquidity. When should we subtract the cash from investing activities? If the cash flow from investing activities was minus, if we invest in any asset, then we have to deduct the cash from investing activity from the cash of operating activity. Okay, and the same thing happened in the financing activity. If the financing activity, if the cash flow from financing activities was negative, then we need to also deduct it from the cash flow from operating. Anyhow, at the end, we will find what we call the net increase or decrease in the cash and cash flow. Sometimes we find increase in the cash. That means we need to compare between two periods. For example, this year and last year. Okay, and we will find we will see if there is any increase or decrease in cash in the period. This is the normal flow of the cash in the business. This is imagine that this is our business, and the business has cash and cash equivalent. We have a cash in the business. The flow of the cash from the operating activities will be to this side. Will be from operating activities to the cash. Why? Because the operating activities, the main objective of the operating activities is to increase the cash. As an example here, if we are a retailer, then we need to increase the cash. We need to increase the sales. Or if we are a manufacturing company, then we need to also increase the cash by increase the products that we are producing and sell it to the market. Okay. Okay, so the operating activities will bring the cash into the business. Okay, whereas the investing activities usually take from the cash. That means here the cash will be outflow. We will have what we call cash outflow. That means we pay to invest in another asset. So the cash flow here will be from the business to the investment. Okay, and financing activities here, the financing activities means that we get some loans, okay, either short-term or long-term loans. By getting this loan, we have, that means the cash flow will be to this direction, from the financing activities to the business. Let me go back here, okay, to explain what is the meaning of cash flow from operating activities. The business, any business, has operations, as we said before, that we have operations, okay? From the operations, like for example, if we are retailing business, okay, our operation is to sell products to the customer, okay? This is our operation. That means any cash generated from the retailing business, we call this cash, we call it cash flow from operating activities. These are our operating. Okay. If we have production, if we have a manufacturing business, then also from producing the products, okay, and sell it to the market, we also get some cash. Okay, and this cash, what we get from selling our products, this is what we call the cash flow from the operating. Okay. Whereas the cash flow from investing activities are the cash that we pay to buy some assets. Okay, like for example, if we buy a new building or if we buy some land, okay, for investment, for future investment, this we call it cash flows from investing activities. Okay, there is another type of cash flows from investing activities, and this cash flow will be cash inflow, not cash outflow, like the regular way of. How can we get the cash from investing if we have investment, and this investment make some profit to us? For example, if we have a building and we rent this building to another company or we rent it as apartments, okay, we can get from this investment, we can get some money. This cash that we get from this investment, we call it cash flow from investing activity, and this will be cash inflow, not cash out, like as usual. Okay, but the cash flows from financial activities, usually it's cash inflow. We get the money from financing, but also sometimes if we want to pay back the loan, okay, this cash that we give it to the lender, we call it also cash flows from financing activities, and this cash flow will be cash outflow, not cash inflow. This is an example of the cash flow statement, and this cash flow statement is for this company. As you can see here that we have net cash from operating activities, and this is the cash flow from operating activities. Okay, as you can see here, we have cash generated from operations. That means the cash. This is the sales. Okay, or the profit. We can call it the profit of business or of the business. And this is the interest that we pay, and this is the tax. Okay, the interest and tax are negative because we pay those amounts, so it's cash outflow. Okay, so we need to deduct those cash outflows from the cash generated from operations, which is this amount, and we will get the net cash from operating activity, which is 3,990, as you can see here. Okay, and the net cash used in investing activities, this is the cash flow from investing activities, and as you can see here, the cash flow from investing activities is negative also. Okay, that means we need to deduct this amount, which is the cash flow from investing activities, from the cash flow from operating activities. And the third part in the cash flow statements, which is the cash flows from financing activity. Dividends paid to equity owners, that means the business give profits or give some dividends, okay, to the owner. And this is the net amount that we give to the owner. Okay, why we put it here negative? Because this is came out of the business. Okay, even though we give to the owners, but we take this amount from the business. That means this is cash outflow. Okay, this one also another other net cash flows from financing activities, and as you can see here that it's also negative. That means we also paid this amount. Like for example, we paid the loan. Okay, we paid some of the loan because this will be cash outflows, and we will also deduct. First of all, we need to find out the net cash flows from financing activities, and net cash flows from financing activities will be this amount, which is 3,036, which is the sum of this amount and this amount. Okay. Finally, we need to deduct the cash flows from investing activities and the cash flows from financing activities. We deduct those two amounts from the net cash flow from operating activities, and we will get this amount, which is minus 900. Okay, and that means this amount means that there is a decrease. Okay, there is decrease in the cash and cash equivalent. That means the cash decreased from the last year. Okay, so this is an example of the cash flow statement, and how can we find out the three parts of cash flow statement. Okay, how can we prepare or how can we, what we call it, deduce net cash flows from operating activities? How can we find out the net cash flows from operating? Okay, because net cash flows from operating activities is the only part of cash flows that we are interested in. The other cash, which is cash flows from investing activities and cash flows from financing activities, will be given to us from the company. Okay, the company has record for all the investments and for all the financing activities. Okay, but the cash flows from operating activities, this is the one that we are interested in. This is the one that shows us whether the business has good cash flows or bad. Okay, we have two methods for finding out the cash flows from operating activities. We have the first one, which is the direct method, okay, and indirect method. The direct method related to the records that we have in the business. For example, if we have computer system, okay, if we have accounting system in the business, we can get the cash flow from operating activities directly from the computer system or from the accounting system, okay, directly by checking the accounts and finding out the receipts and the documents that we have in the system, so that we can find directly the cash flow from operating activities. Okay, and this is a direct method. This is it's not complex. It's very easy to get it from the accounting. The other method, which is the indirect method, we can get it through this chart. Okay, this is the indirect method of reducing the net cash flows from operating. Okay, in the income statement, we have the profit before taxation, before tax. Okay, in the income statement, we have this amount, which is the profit. Okay, and also we have the tax. That means we need to to add the tax, we need to add the tax to the profit first of all, to get this amount, which is profit before tax. Okay, and then also we have also the depreciation in the income statement. We also add this depreciation, and if we pay also interest, then we need to add it to the amount, to this amount. Okay, so that means here the profit before taxation plus depreciation expenses plus interest expenses. Okay, and then after that the inventory, if the inventory increase in the period, okay, then we need to deduct this increment or this increase. If the inventory decrease, then we need to add this decrease. Okay, let me complete this one, and then after that we will have a small example of this indirect. Okay, this is regarding the inventory. If the inventory increase, then we need to deduct it. We need to make it minus from this amount. If the inventory decrease, then we need to add it or plus it to the amount. The account receivable. The account receivable, the same thing. If it's increased, then we need to deduct it, or if it's decreased, then we need to add it to this amount. The account payable. Okay, the account payables, you know that the account payables are the cash that we need to give it to the suppliers. Okay, we have to give it to suppliers. That means if the account payable increased, okay, that means we did not give it to the supplier. That means we need to add it to this amount. Otherwise, we need to deduct it from this amount. Okay. And then after that we have those three items, which is the interest paid and tax paid and dividend paid. Those are all we deduct them all from this amount, and then we will get the net cash flows from operating